Earning your degree online doesn't mean you have to go about it alone. At Capella University, we're here to support you when you're ready. From enrollment counselors who get to know you and your goals, to academic coaches who can help you form a plan to stay on track. We care about your success and are dedicated to helping you pursue your goals. Going back to school is a big step, but having support at every step of your academic journey can make a big difference. Imagine your future differently at capella.edu.
You're listening to a Mint podcast brought to you by HD Smartcast.
Hello everyone and welcome back to another episode of the Why Not Mint Money podcast. DSP Mutual Fund is betting on Hrithik to make a comeback. Hrithik is short for big companies in the Nifty index. H is short for HDFC Bank, R for Reliance Industries, I for ITC, T for TCS, I for Infosys, and finally K for Kotak Mahindra Bank. DSP believes that large companies are available at attractive levels as investors have lately favored small and mid-cap stocks. Accordingly, they have launched an equal-weighted fund for the first time in India that will invest in the top 10 companies by market capitalization. Sahil Kapoor, market strategist at DSP Mutual Funds, joins us to discuss the details.
Welcome to Why Not Mint Money, a personal finance podcast where we help you understand basic money concepts and share strategies for you to build your wealth. So let's get started with your money journey.
Hi Sahil, thank you so much for coming to this episode. And yes, how have you been doing? How was your day?
Very well, thank you very much for inviting me.
The day has just started, so I'm sure nothing much would have happened till now. But yes, anyway, Sahil is part of the DSP's marketing team. He heads, I think, the product division, right?
Yes, I head the products team and I'm also the market strategist for the team.
So Sahil, DSP is launching this NFO called the Nifty Top 10 Equal Weighted Index Fund or ETF. So I heard it's the first of a kind fund in India. So just wanted to know how it is different from existing fund and why do you think this fund will be suitable in a person's portfolio in today's time? And maybe if you can explain it in complete layman's terms, that would be really great.
So Sachin, this is actually a very simple idea. So what we are doing is, all of us know that the top 100 stocks are large caps in India, right? And the Nifty 50 is the 50 of those first 100 stocks. When you take the first 50, it becomes the Nifty 50. But when you take the top 10 stocks by market capitalization, they will become the top 10 stocks. And when you equal weight them, which means 10% given to each stock, 10% weight given to each stock, it will become the Nifty top 10 equal weight index. Right? So it's a very simple idea. There is nothing beyond these three things which I told you. It's a very simplistic idea. What is the rationale behind looking at the strategy? And as you asked me, how different it is. When you go to, let's say, Nifty 100 index, when you do a market capitalization, or let's say, for example, if you take Nifty 50 index, what you will get is the top, let's say the top 10 stocks will be close to 54% of the index. And rest of the stocks, the 40 stocks will be around 46% of the index, right? So it's a plain vanilla index based on what we call the market factor or market capitalization, right? So one or two stocks will be over 10% in weightage, 13, 12, and many other stocks will have lesser weightages. So it will depend on what is their free float market capitalization. So Nifty 50 broadly is all of us know that it is the market, sort of the standard index that everybody tracks. When you want to beat Nifty 50, how do you beat Nifty 50? So one way is to go to active funds, which will have their own active weights and try to beat Nifty 50. The other way is to think about a simplistic structure. So back in 2017, we came out with a product called Nifty 50 Equal Weight Index. So rather than using the free float market capitalization criteria, we said there are 50 stocks, 2% to each. It will become an equal weight strategy with Nifty 50 stocks. And over the last 5 years, that strategy has beaten almost everything else, including the Nifty itself. So which means the question we wanted to ask is, how do you make a more diversified Nifty 50 using the 50 stocks itself, right? So there is a standard Nifty 50. The Nifty 50 equal weight is a more diversified version of Nifty 50 because you are giving equal weight to all the stocks. So you get a more diversified version. Now, we said that can we launch a product which is more concentrated in nature? So Nifty Top 10 Equal Weight Index is a concentrated version which takes into account the top 10 stocks only and then equal weights them. And there are two reasons for picking the top 10 stocks. One, that this segment of the market has a extremely low churn. Over the last 10 years, only two stocks have changed in the top 10 basket, which means that it's a very, very durable portfolio. It has some what is called a Lindy effect. Maybe we can talk about it later. Second, because it's an equal weight strategy, you get an appropriate mix of different stocks without going 15% to anything or falling to 2 or 3% to anything. So it gives you a very, very optimum exposure at this point in time. So as of today, if you want to participate in the largest stocks, we can chat about it. Why? Exposure to largest cap companies for a long time.
So Sahil, one thing that I found interesting while we were talking is that I think you mentioned in the last 10 years, only two companies have, gone out of the top 10,
Basket,
space
yes.
and basket. So my next question is, how will you manage the churn? So let's say, what is the frequency that you plan to churn the portfolio with? Because in the last 10 years, only two stocks have gone out and come in. But tomorrow you may wake up and see a lot of another company coming in. Some company might go bust. So how do you plan to manage bring in and out companies from the portfolio?
First thing is that we are not going to change anything based on our discretion. It's a index based on NSE's own formula. So it is a passive product. It does not have any discretion, so to speak, at our end. Second thing is that it has a 6 monthly reconstitution. So every 6 months, the index provider will give us what are the constituent of the index. But every 3 months, the weightages will be brought back to 10% each. So every 3 months, you will see that all stocks will go to 10% again. If they have gone up or gone down in price, the rebalancing will happen. And every 6 months, a reconstitution will happen. And that is a segment where I said over the last 10 years, the churn has been very, very low. Okay. Second thing is that what if something goes wrong, right? If one company, there is an event or does not perform or there is a problem. Historically, among the top 10 companies, we haven't seen any accident as of date, right? It does not mean that we will not see in the future. The only thing is that we haven't seen over the last 30, 40 years. There have been certain accidents in the top 50 stocks. We have seen some of them play out over the last 15 years also. But the top 10 stocks as of now has been they haven't seen this kind of an event. Second, most of these companies are market leaders, right? Their balance sheets are much more stronger than the rest of the market. So there is a probability, not certainty, but a probability that this is a more durable portfolio. And third thing, as far as the churn is concerned, as I said, the churn is low. Even if the churn were to be high, let's assume that it is high and every 6 months you are seeing 2-3 stocks go up or down. Even in that case, this universe is the most liquid universe in the Indian market, right? So there is no reason to believe that churn could cause a bleed or could lead to any significant changes, right? So it is going to be much easier to do in these top 10 stocks.
So Sahil, let's shift to another angle, which is, nowadays a lot of people are getting interested in the small cap and the mid cap space. Mm-hmm. So when a lot of money is going in that part of the market, why have you decided to launch a fund, particularly focus in the larger company? Do you see any structural benefit that, that you can take out of this, kind of euphoria that is happening in the small cap space?
So, Sachin, just a few years ago, India had a phrase, or for that matter, globally, there was a phrase called big becoming bigger. People were talking about large companies becoming even more bigger And the primary reason why people were talking about this trend was that large companies had very strong balance sheets and they had a lot of money on technology, ability to withstand crisis, and therefore they were becoming much bigger. And this trend played out in United States to some degree. Even in China, large companies have done better than the smaller companies, and in many other parts of the world. So when you look at, let's say, the US counterpart, top 10 companies in S&P 500 has outperformed S&P 500 by a very wide margin since the COVID bottom. In fact, they have outperformed the S&P 500 companies, the top 10 companies, by a very large margin over the last 15 years, right? So it's not a phenomena that is only subject to India. Why we are launching it here today? The whole market is right now geared towards thematic sector, small and mid caps, right? When you look at the active fund flows over the last 6 years, only 1 out of 10 rupees has gone to large cap space. Okay. How does it, just to put these numbers in context, large cap stocks account for 70% of market capitalization, more than 70% of profits, more than 75% of free cash flow. But they are getting only 10% of flows, right? Which means that everybody is chasing the other part of the market. Now the question is why? The reason is that last 3 to 4 years have produced stellar returns for that part of the market. And we've seen historically most investors end up chasing returns. Okay. So when you go out in the marketplace today, what are you being offered? Thematics, sectors, small cap, mid cap. Reason? It's an easy sell, great returns, no questions asked. What we are telling people that this part of the market, has underperformed, therefore the price froth is absent. B, on a valuation basis, it is much more attractive. So for example, if a Nifty 50 has an ROE of 16%, this portfolio has an ROE of 22.5%. If NSE 500 or Nifty 500 is trading at price to earnings multiple of 28 times, this universe is trading at 23.5 times. So much lower than the broader market, right? So no price froth. B, better on valuations. C, nobody is heading this way, right? Everybody is heading the other way. And if you are going to look at your asset allocation, because small mid cap themes have done exceedingly well, in your own portfolio, their weightages would have gone up, right? So if you want to rebalance your portfolio today, you would want to add large caps. And we are saying the largest cap companies is the best place to be right now. And therefore, this product at this point in time, time-wise, it is an excellent time. Maybe one small data point I'll throw here. The weightage of top 10 companies versus the entire market capitalization of India is at an all-time low today, right? And therefore, the margin of safety for these companies is exceedingly high. So their profit pools are going up while their weightages have come down. So it's an excellent opportunity to add to your portfolio today.
So Sahil, one interesting thing that I wanted to know from you is that, I was of the opinion that, the top 10 companies would have a very concentrated sector allocation, in the sense it would mostly comprise of banking, BFSI companies plus the IT companies. What is your opinion on that? Do you think by taking a portfolio which is top 10 stocks, are you taking a concentrated sector bet in that aspect? How do you think about it?
So as of today, see, because it's an index and it will have its own reconstitution, but when you look at the portfolio today, you get about 40%, the top 10 stocks, 4 are banks, okay? 2 are IT companies, 60% of the portfolio, 2 are FMCG companies, 80% of the portfolio now. And the rest 2 are from different, one is oil and gas Reliance, which is a diversified conglomerate. And then there is L&T, which is again a diversified, more a capital goods construction company. So you have exposure to around 5 sectors in totality. But you're right, the overbearing exposure is coming from BFSI and IT, almost 60% of the portfolio. Why we think this is the right matrix to look at today, I'll explain to you in 2 points. One, BFSI or banks particularly is the sector which is trading at its average or below average valuations. So think about it this way. When you look at the Nifty 50, it is trading at about 24 times trailing earnings. When you exclude banks from Nifty 50, the universe is trading at 28 times earnings. So it becomes more expensive. But when you look at just the banks, they are trading at about 17, 18 times. So this segment is much more cheaper versus the broader market at a time when the broader market is trading at a huge premium, historical premium, right? So this is one of the most attractive places. Second comes the IT companies. They are not certainly cheap versus their own history, but they are not expensive as they were just 2-3 years ago. So that universe does not have price froth, right? It has underperformed the market over the last 2 years. So certainly the price froth is missing. And third, again, the FMCG companies have underperformed blatantly the broader market over the last 2 to 3 years. So when you look at 80% of your portfolio is either available to you at good valuations or without price froth, right? So this makes it a very, very attractive proposition. And as far as diversification is concerned, I'm sure that people who have bought small cap, mid cap, broader markets, themes, their portfolios are already very, very well diversified, right? And therefore, creating a more concentrated large cap exposure will be a better addition to their portfolio.
Interesting perspective. So Sahil, now coming to the end of the discussion, no investment discussion is complete without talking about the downsides, right? So do you want to talk about some of the potential downside or not so good part of investing in the top 10 equal weighted stocks?
Sure. So first thing is that I was looking at some data today and I plotted, 4 or 5 indices. I plotted Nifty 50, then I plotted Nifty mid cap 150 and small cap 250. And then I plotted the entire market, which is Nifty 500 index. And then I plotted the Nifty top 10 equal weight index. And the data started from the 2006, which is where the data is available from. And what is noteworthy is that up until just about last year, June, starting data point is from March 2006 to about last year, June, Nifty 50 equal weight, Nifty top 10 equal weight index was performing better than almost all other indices, right? Over the last, you could say almost 17 years, right? Whether you compare it with mid cap, small cap, large cap, etc. But this is the full cycle picture, right? You would have had to stay for 17 years for this performance to play out. What is the downside? The downside is that if you have a very strong, preferably strong bull market for small and mid caps, this will underperform in that kind of a market, right? When small and mid caps are outperforming by a very, very wide margin, this can underperform in some of those instances. Second, that underperformance may not be very large, but it will of course be visible to you. Second thing is when you have a very large declining market, right? For example, a big crisis period like a 2008 or a COVID crisis, this kind of a portfolio will be very durable, right? It will hold you in very good stead. It has seen lower drawdowns compared to the rest of the market. In fact, let me point out a phase to you, which is 2018 and 19. That was a phase where in India, a term called Hrithik stocks was coined, where these large cap companies were outperforming everything else. In those 2 years, the NSE 500 index fell 2% and then rose 9% next year. But this portfolio rose 19% each of those 2 years, right? So delivering a huge amount of alpha. So one, what is the risk in this strategy? A, that if there is a blatant bull market, outright bull market, this portfolio might underperform. What is the use case? That in a crisis period or a large bear market, this is a portfolio which is much more durable and has the higher probability of doing much better than the broader market.
Interesting. Now, Sahil, okay, so the bottom line for investors is that, you're saying this is not for very short-term investment. Right? If you want to reap the benefits properly of this, then you should stay invested for at least the full cycle, which would be, I'm assuming, at least 10 years.
See, I'll tell you that it's very hard to put a number, right? So, for example, we've seen that Nifty 50 equal weight as a strategy has done exceedingly well over the last 5 years, right? And we think that cycle has played out brilliantly. Today, we feel that a more concentrated portfolio, a Nifty top 10 equal weight portfolio could do well. So similarly in US, when this strategy had a huge margin of safety, which means that the largest cap companies were available cheaper, and had you entered that strategy with a horizon that in the next 2 to 5 years I'm going to reap benefits, but that strategy went on to do well for almost 9 years, right? So as of today, we know that there is margin of safety, that it's a good entry point. It may not be the best. We don't know which is the best point, right? The best point was like a COVID decline. So we can't predict that. We have no idea. But this is a very good time to enter this kind of strategy. How will the exit pan out? We don't have any idea. Maybe in 1 year it creates a huge outperformance, or maybe it takes 5 years. We have no idea. So the outperformance can persist for a very long period of time. Starting today, the only available piece of information that you have is that you have a good entry point because you have good margin of safety. Exit or full cycle, maybe we'll come to know later as the markets progress.
Interesting. So, Sahil, also one another interesting trend we're seeing is the growth of factor-based fund in our country. Even we wrote about it today, saying there has been a boom in the launch of factor-based funds like this one, which is not actively managed, but which follows a certain formula kind of structure. So, what do you think about this trend? Is it good for the investors? Is it not so good? What does it say about the appetite of Indian investor and changing investment approach?
So Sachin, I have a very simple answer. When as investors we pick stocks or pick strategies, we make mistakes because there are behavioral kinks in our understanding, right? We are emotional and we take decisions which are emotional. Any formula, which has good grounds up rule or which follows the first principles of investing. For example, we've been focused on the quality factor, which takes into account that whatever companies you select, they should be of high quality, right? This is one factor. Of course, there are many other factors available in the market. If the factor takes into account first principles of investing, it will allow you to make no or very few mistakes, right? And that is a use case for factor investing, that it eliminates to a very large degree errors of judgment from investors, and therefore I think it's a very, very good structure to have. Second thing is that it is also a low cost structure to participate with set rules. So I think it is here to stay. There is no doubt about it. And because it eliminates emotion and gives you a more disciplined way of investing, it might be a very good vehicle for a very large number of investors who are not adept at picking stocks or investment strategies.
Interesting. So, Sahil, also wanted to ask, when is the fund opening, the DSP Top 10 Equal Weighted Fund?
Yes, so we are launching the DSP Nifty Top 10 Equal Weight Index Fund and DSP Nifty Top 10 Equal Weight ETF. The NFO will start on 16th August and will end on 30th August.
So, who should apply for the ETF and who should go for the passive fund instead?
I think there are clear use cases. There are a lot of investors who are very comfortable with, ETFs because it comes into the demat and they are comfortable holding it there. And second, a lot of people who do not have demats or don't want to participate through ETF stock exchange purchases, they can directly go and purchase an index fund in their portfolio. So it is the same underlying index. There is no difference in the strategy. Overall experience will also be very, very similar for investors. So it is particularly based on investor preference, and that is why we are putting both of them on the block.
Interesting. Okay, so Sahil, before we let you go, you do a lot of interesting stuff at DSP, the kind of research you produce, and can you talk a little bit about it? What's the thought behind it, and how do you come up with ideas to bring out research and show it to distributors, investors, researchers, professors, journalists, etc.?
So our idea is that we want to present, principles of investing that work. Second, we want to bring forth data and facts which are logical in nature rather than opinions. So we are trying to present to people useful data points that will allow them to take good investment decisions. So because your opinion or my opinion is equally good or bad, we only know in the future how strong or weak it was. But data and facts are very useful. They allow us to understand cycles. And through all the clear data insights that we are presenting, our only endeavor is to help people take a better investment decision. So that is a driving force. How do we do it? We track a large number of markets. We have a very strong 20 analyst team at helping us understand all the business cycles. And also we take a very strong and deep look at unit level economics of businesses. And when we combine these two factors, we are able to produce some of the research that we come out with.
Interesting. I know for a fact a lot of people follow your research, and kudos to it. Before we let you go, if you have to give one advice to any investor watching this episode, what would that be? And I'll give you only one chance.
Yeah, so if there is an investor, who needs only one advice, it is that if you invest through a systematic investment plan, if you start a SIP, that is the first thing that you should do. You should not stop it and let it run forever. If you do these two things, then you don't have to listen to me, read my research, or follow any other protocol. And this is the only investment strategy, the simplest one, which works for a very long period of time. And that is what you should follow. And if you're disciplined enough, then this is enough. There is nothing else to be done.
Great. And with that, I think we have come to the end of this episode. And thank you so much, Sahil, for taking out your time, and hope to see you again.
Thank you. Thank you very much for having me.
That brings us to the end of today's episode. If you would like to know more about this topic, then you can reach out to me on Twitter. I go by the username @SashinNJ, or LinkedIn using my full name, that is Sashin Ningthaukhongjam. We would be happy to take your suggestions. That's all from our side. Thanks for tuning in. See you in the next episode.
To stay updated on this podcast, follow us at HT Smartcast on all the major social media platforms. To listen to more such podcasts, log on to www.htsmartcast.com.
Imagine earning a degree that prepares you with real skills for the real world. Capella University's programs teach skills relevant to your career so you can apply what you learn right away. Learn how Capella can make a difference in your life at capella.edu.